So we're going to go ahead and get things kicked off now. Again, my name is Andy Barton. I am one of the CFPs here at Boldin. I'm going to introduce you to Brie Black here in a second, who is another one of our CFPs. And then we have Sarah and Nancy on the call as well, too, here from Boldin. So again, I'm Andy. I'm in Columbus, Ohio. I'm really excited. It's sunny out. Spring is finally here. We're going to our first baseball game tomorrow night. So really looking forward to that. I've been doing this for almost 20 years now. This bio's a little bit old. This is actually my 20th year in the industry. I come from an accounting background, so I really geek out on things like Excel spreadsheets and the Boldin software. So things like Roth conversions, when to start Social Security, how to effectively withdraw from your portfolio as you're into retirement and things like that. I really, really like to do and help our clients with. Again, I'm an Ohio State guy, so I'm here in Columbus, Ohio. This is all I've ever done my entire career is financial planning. So you'll find out pretty quickly that I'm passionate about it and really do enjoy it. I will let Brie introduce herself and then we'll start answering some questions.
Awesome. Thank you, Andy. I'm excited to be doing this again with you. We've had such good reception on these big office hours for all Boldin clients. So I have been in the industry for over 10 years now. Again, I have also only ever been a financial planner. I was in a client meeting my very first day on my very first job. I have kind of gone through a similar process of working in the back office of different accounting firms and a tax planning centralized firms in financial planning. My passion is in really big long-term tax planning issues. So making sure that we're paying the least amount of tax possible over multiple years of your retirement. I like to also incorporate multiple generations of your family. So making sure that we're keeping taxes low for you, for your surviving spouse, for your kids. If you want to give money to charity, we're doing that in a tax efficient fashion at all times. One thing that I really love is making sure that all of the recommendations I prepare for clients are really based upon how they think about money. So I spend a lot of time with my clients, really getting to know them, understanding how they think about things, and how involved they want to be with their financial planning process. I am in San Antonio, Texas. We've been in spring for, I don't know, the whole time. We don't even get winter here, but I'm enjoying, it's about to be fiesta season, these parts. So having a nice time here in San Antonio.
Very cool. I think I misspoke at the beginning. I think we disabled the chat, but we've got Q&A rolling. So I see a bunch of people posting in there. There are people that have been using this software, it looks like for 5 to 6 years is the longest I've seen. And then some are like less than a week. So welcome to Boldin. As you can tell, there's people kind of all over the map with their experience. So we're going to do our best to answer a lot of these questions and get you feeling really comfortable and confident in using the software. At the end of the conversation, we'll also let you know some of the options that you have available, whether it's you want to keep being a DIYer and doing this on your own with our software, which is great. There's an option where you can work directly with what we call a coach, and that coach will help you get the most out of using the software. So maybe you might want to know, hey, I want to do Roth conversions through this tax bracket. How do I do that inside the software? Or I'm expecting an inheritance, or how do I compare a pension lump sum to taking the annuity option? Using the software, a coach will be able to help you get the most out of that. If the questions are more in line with needing advice, so if the question isn't where do I put a lump sum pension, it's should I take the lump sum pension versus the annuity, or should I do a Roth conversion and how much and things like that, you're able to meet with one of the CFPs as an advisor relationship that you see on the screen. And again, at the end of today's call, we'll walk through the next steps and the options that are available. But all the 12 advisors you can see on the screen right now are CFPs. We all work as a fiduciary. We all work here at Boldin, which means that we provide advice only and fee only. So just real quickly on this, a lot of advisors in the industry charge a percentage of assets. So 20 some years ago when I started, things were moving from the commission base to, hey, I'm going to sell you a mutual fund or sell you an annuity or life insurance, and I'm going to get paid an upfront commission. In the early 2000s, this 1% number, and no one really knows where it came from, just kind of started. And they said, great, Sam, you've got $1 million of investable assets. I'm going to charge you 1%, or I'm going to charge you $10,000 a year for my services. So obviously, if you've got 2 million compared to 1 million, you're paying twice the amount in fees. Well, fees have kind of caught up. There's more communication. There's more things available online. They've been a hot topic the last dozen or so years. And firms like Boldin have started that charge just a flat dollar amount to receive this advice. So obviously we're biased, but we think a flat fee is certainly the way to go. It makes things more affordable, and it also removes all conflicts of interest when it comes to providing this advice. Advice only means that's what you're going to get when you work with somebody like myself or Brie or any of the 10 other planners on the screen. We're not going to take custody of your assets. We're not going to charge you 1%. We're going to sit down and have a couple of really detailed conversations, and you're going to walk away with answers to the questions that you have. So very specifically, things like you should do a Roth conversion through this tax bracket. You should start Social Security here. Hey, based on your risk tolerance, you might be too conservative for where you need to be. We recommend selling these funds and moving into these types of funds. So you're going to walk away with that advice, and then you can do the implementation on your own. Again, this provides us being advice only, a fee only, and fiduciaries at all times, which really sets us apart in the industry. And we'll talk about what the next steps are here at the end. But we're going to kick things off by, oh, I forgot this slide. I always forget this slide. The important disclosures. So read through this. It's our legalese saying that we're not giving specific tax advice. If you want specific tax advice, meet with your tax decider, CPA, whoever you end up working with. But we are going to kick things off with the question. So Brie, I'm going to hand it over to you for question number one.
Awesome. Thank you so much, Andy. So this question is, what are the key factors in deciding when, how much, and in what sequence to do Roth conversions? This is one of the biggest questions that we answer for our clients, is doing a full-scale Roth conversion analysis for them. Kind of the main things that we're looking at are, what's the rate of return being generated across your various accounts? What is the income that we need to provide for you, right? Like, what is your spending level? We're never going to suggest that we lower your spending in order to do more Roth conversions, right? So we build on top of those things. And then we set limits based on, if you're trying to stay under the ACA subsidy limits in the early years of retirement, we can build Roth conversions around that. We will also build Roth conversions around what tax bracket you may want to stay in for whatever purpose. And then we have a detailed conversation with you about what are your overarching goals with the Roth conversion. So is it, lowering taxes across your lifetime? Is it providing a tax-free inheritance to your kids? We'll also have a conversation with you about your estate planning goals. If you want to give a bunch of money to charity in retirement, then maybe we don't convert every dollar to Roth. We save it to do qualified charitable distributions. Or if all of your money is going to charity at the end of your and your spouse's life, well, let's be strategic about how we leave money and how we spend money over time. In general, how much is to do in Roth conversions is influenced by all of those factors. In what sequence to do Roth conversions? Again, in general, the earlier you do Roth conversions, the better. A single dollar growing in a Roth account is more valuable than a single dollar growing in a pre-tax account, right? At the end of the day, the government owns 25% of your 401k, no matter what you do with it. So the earlier, the better, but we can limit that based on whatever's going on in your income stream.
All right, on to the next question. Can you explain the actual steps and detailed mechanics to complete and report a mega backdoor Roth, a backdoor Roth, and a Roth conversion? So there is a lot in this question, so we're going to walk through it a little bit slower. So I'm going to start by talking about just a simple Roth IRA. So if you want to put money into a Roth IRA directly, there's really two requirements. One, you have to have income, so you have to make money. And two, you have to make an income lower than about $250,000 if you are filing a married filing jointly return. So if you meet those two requirements, you can stick $7,500 directly into a Roth IRA this year. Even a little bit more if you are over a certain age limit. So you can do it directly into a Roth. This question is more designed for those people that probably don't meet those requirements, but still want to put money into a Roth. I'm going to go a little bit out of order here. I'm going to start with Backdoor Roth. So the same requirements are needed here when it comes to income. You have to have income in order to do this. But you're able to put money into what's called a non-deductible IRA. So you can take that 7,500 bucks and you can put it into this non-deductible IRA. And then unbeknownst to me, the IRS makes things a little bit complicated. You can do that and actually convert it right away. So once that money's in your Schwab or Fidelity account, whatever it is, you put in 7,500 bucks, you wait a day, you can convert that money right away from that non-deductible IRA into a Roth IRA, and you pay no taxes on it because you didn't get a tax break when you put that money in. So you're able to do that. There's just a couple more steps and a form you have to fill out. I do want to point out there is a very important rule that sometimes gets skipped here, and it's a pro rata rule. So let's say that you have a 401k from an old job that you've moved into an IRA, and all of that money is pre-tax. And then you put in this 7,500 bucks because you want to do this Roth conversion right away. Well, as you do that, you can't specify what money you are going to convert. So if you've got $100,000 in your old 401k in an IRA, and then you put 7,500 bucks in this non-deductible account, you can't say, I'm going to convert this 7,500. All you get to say is, I want to convert 7,500. And then it's a percentage base of how much your old $100,000 pre-tax account and your $7,500 non-deductible gets transferred over. So in essence, you're not going to do a $7,500 backdoor Roth IRA if you have other IRA accounts already available. This is a really important thing to sit down and talk with your financial advisor or your accountant about to make sure you're doing what you want to do on this. The next one is a massive one that's become popular the last dozen or so years is the mega backdoor Roth IRA. This is available through your current employer's retirement plan. I do want to point out this does not exist everywhere. A lot of employees and employers do not have this available to them, but some do. And if this is the case, let's say that you want to put as much money into your Roth as possible at your employer. Well, you can put in this year about $24,500 into a Roth 401k if it's available to you at your employer. And then let's say there's a match and the company puts in $5,000 to match you. Great. So you've got about $30,000 already put away. But there is a number which is $72,000, which is the max that you can put in. So if you have the nicest employer in the world and they say, great, I put in $24,000 and we're going to match you with twice as much and put in $48,000, awesome, you're already at your limit. But most places, when you put in 25,000 bucks, you might get $3,000, $4,000, $5,000 of a match. So there's a lot more space left there that's going unused. If your company allows it, you can then put in after-tax money into this plan. So let's say you've got $40,000 more, you can throw $40,000 more into your plan. It's considered after tax. But just like earlier, we can then convert this right away, move it into a Roth, and it will be treated just like your other Roth money that you have already put in. So I know that's a lot of numbers and things to do, but if your company allows for a mega backdoor Roth IRA and you've got some extra money that you don't need and Roth makes sense for you, absolutely something for you to look into. The last one on here is a Roth conversion. The Roth conversion is the only thing that you can do on this screen where you don't have to have income to do it. So you're able to just take old money that's inside a traditional IRA and convert that over to a Roth. Just like Brie was talking about on the slide before, there's a lot that goes into figuring out how much, when, and does this make sense for you to do. There's really good things of a Roth, and there's some things you might miss out on. I know some people have commented about things like IRMAA and things like losing ACA subsidies inside of the chat. Those are absolutely things that might happen by you doing a Roth. So we want to make sure that it makes sense for your entire situation. We always laugh and we say that, hey, changing one thing to make it better might make other things worse, or you might have to change those. So as you start going through and doing things like a Roth conversion, maybe you need to change your social security plan or your income plan, or maybe you need to choose your capital gain strategy, your tax loss harvest. So all of these things are going to work together. I know that was a super long response, but a very, very detailed question. I'm going to take a breath and hand things back over to Bree for the next question.
This is, I think you've kind of touched upon this. How do Roth conversions, investment income, and other planning decisions interact with IRMAA surcharges and Medicare costs? How should you model healthcare expenses across retirement? So, yes, absolutely. As your income increases, if you are purposefully increasing your income through Roth conversions, if you get over that first IRMAA threshold, you start to pay an additional $80 a month on top of your standard Medicare premium. Part B this year is $202 a month. The first tier of IRMAA is an extra $81 a month. So it's pretty expensive. And then it ticks up from there. So you can have really, really high IRMAA costs. Now, the thing to remember about IRMAA is that it's not based on your current year of income. It has a 2-year income look back in it. So if you're on Medicare today in 2026, they're actually looking at income from 2024 in order to determine today's IRMAA amount. Roth conversions, oftentimes we use that as a tactic to decrease IRMAA over time. If we kind of let the money hang out in the pre-tax IRA and then you've got really high required minimum distributions in your 70s and 80s, that can trigger IRMAA as well. So oftentimes we'll do some more aggressive Roth conversions in the earlier years of retirement, perhaps increase your IRMAA strategically in those years or in the years following those Roth conversions in order to decrease it across your life. So again, it's a trade-off. Oftentimes we're focused on what's the impact over your entire life and understanding that that comes at a cost. How should you model healthcare expenses across retirement? I really love that we have a separate inflation assumption for healthcare costs because, as we all see, that increases much faster than other costs in our economy. So you're able to make strategic decisions on how much you anticipate your healthcare costs to increase over time. We do have a recommended historical average that you can use as well, but you can always increase or decrease that based on your own lived experience and research. And I always like to make sure that, number one, we're accounting for premiums. So you can use the estimator tool inside Boldin. You can use the itemized tool inside Boldin and put in your exact Medicare costs, your exact healthcare costs. If you've already gone to sign up for your Medigap plan and your drug plan and all of that good stuff, you can put in your exact expenses. I always like to include a few line items there for like out-of-pocket costs or hitting your deductible in the years that you expect to hit your deductible. You can also add in, if you're on a high deductible healthcare plan in the early years of retirement and you know that you need to have knee surgery, if you call down to your physician, they are required by law to tell you how much those things are going to cost you, and you can even budget for that if you want to get really detail oriented in it. But again, these are all estimates. We want to make sure that we're regularly reviewing those estimates and updating them over time. Was that enough of a break for you, Andy?
That was good. That was good. I'm feeling better.
Okay.
All right. So I'm going to answer this question while not being political or giving opinions and things like that on kind of what's going on right now in the markets. But how should retirees adjust their asset allocation given current market valuations, political and economic uncertainty, and shifts in personal risk tolerance? And what signals indicate it's time to rebalance? So, I think one thing that we do a really good job of is setting up a plan that understands not every year is going to be a positive year in the market, right? I was lucky to graduate college in 2007. So 2008 was my first year putting money into this 401k thing. And all I did was lose money, right? So it was really hard to understand, like, hey, let's not do this anymore. Let's go spend money on things that my friends are doing as opposed to saving for retirement, right? But it's just about understanding truly what your risk tolerance is and also what your financial plan says your investment allocation needs to look like in order to make things successful. So we don't certainly recommend making changes based on, current valuations or current things going on, in politics and the economy and things like that. However, there is something in here that says if there are shifts in personal risk tolerance, and that is certainly a time where we're going to make adjustments for that. So while I say, hey, you don't make changes with what's going currently on, if things change, like you get 5 years closer to retirement, or maybe you had an unexpected medical expense, or you're dealing with long-term care, or there is a divorce, or a marriage, or a child, or whatever it ends up being, as life changes, you certainly need to make changes to your investment strategy. When it comes to general rebalancing of a portfolio, you can imagine helping some DIYers. There are people that certainly love being involved in this and people that don't want to be involved. I've got clients that check their statements every other day, even though we tell them not to. So when it comes to a general rebalancing, we usually recommend quarterly, semi-annually, somewhere in there. Some people that like to be a little bit more involved might put like a tolerance band around it. Maybe it's 10% or so. So if you're supposed to have 30% in a large cap equity fund, and that goes either up 10%, so to 33% of your portfolio, or down 10%, so less than 27% of your portfolio, you can go in and make these adjustments. I wrote down some numbers just because when I first heard this stat, I didn't believe it. But 2008, we all remember how bad that year was in the market. But during 2008, it was almost a 50-50 split on days that were positive in the market versus days that were negative in the market. So it's one of those things like, wait a minute, I thought the market was down 38%. Yeah, it was, but still half of the trading days the S&P was up and half of the trading days the S&P was down. And there's all these stats that are around that, hey, yeah, timing the market's the hardest thing to do. If you miss just the best 10 days in the market, how much lower your performance goes over time. So I would encourage you to look at it. That's why we're really big fans of setting up the right asset allocation at the start. We do sequence of return risk. There's also a market risk explorer inside the planner where you can go in and say, hey, great, I think I'm going to average 7%. What happens if I don't, right? What happens if the year I retire, the market goes down by 30%? Or what happens if there's another lost decade where the market only does 1% per year for the next 10 years? You can throw all of these different assumptions at your plan to see how it reacts. All right, I'm going to hand things back over to Miss Brie for the next question.
Andy, if I can just add in like two small things
Yeah.
to your last question, I think a lot of times, and you can agree or disagree on this. A lot of times when we see market uncertainty, we just feel the urge to do something about it, right? We want to respond to it in some way, and rebalancing is often the thing that we all come up with. But there are additional things you can do while the market is down in order to take advantage of the down market. So, like, tax loss harvesting is the clear one, making sure that your cost basis settings are set on actual cost and you're going in and looking at the individual lots and you can sell individual lots If you have a dividend reinvestment that is recent and it's at a small loss, or it's a longer term dividend reinvestment, you can sell it and capitalize on that loss and carry it forward as long as you can. Also, I really like accelerating Roth conversions during market uncertainty. If you know that you're going to do a $50,000 Roth conversion at the end of the year, doing it while the market is down is a great way to capitalize on that. You're paying taxes on a lower amount, and then you get to see the market recovery inside of the Roth. That's a really cool thing to see happen as well. Okay, I'll do my actual assigned question now. What withdrawal strategies, including guardrails, spending rules, and account sequences, best balance income reliability with portfolio longevity, especially as markets move? Okay, so I really like to help clients choose a withdrawal strategy that takes into account these factors, but really emphasizes their desire for administrative burden, really. How often do you want to be checking on your accounts? What's your process? Are you a big spreadsheet person, or do you just want to look at account balances and carry on with your day? The one that I most routinely recommend to folks is a rebalancing through cash flow strategy. So, that's honestly, in my opinion, the easiest process out there. Guardrails is great. That takes into account looking at your rates of return over time. That can be helpful. The three bucket rule is one that's really popular, but in my opinion, it has a lot of administrative work to it. Rebalancing through cash flow, you set those target allocations for your asset location, like Andy and I have been talking about, and you have those kind of rebalancing targets for yourself as well. But essentially, every 3 months or so, every quarter, you log in, you take a look at all of your accounts, even if you're only following a traditional withdrawal order and you're pulling from your brokerage account in the early years of retirement, or you've moved on to pulling from your 401k. You look at all of accounts because we practice asset location here. We want to make sure that the right investments are living in the right type of account for their tax status. So not every account is identical in asset location or asset allocation. So we say, all right, we're targeting a 60/40 portfolio. We're currently 63% stocks and 37% bonds and cash. And then you sell from the stock side because it's over its target. I think that that's really easy, and it kind of allows you to kill two birds with one stone, making sure that we're rebalancing regularly, we're taking into account how the markets are performing, but we have a very clear exercise on what do we sell in order to generate our cash flow in retirement, and it kind of forces you to buy low and sell high over time.
All right. I think this is our last set question, and then we'll be able to jump into the Q&A and take a look at things. There might be one more after this, I'm not 100% sure. So, what are the most tax efficient approaches to charitable giving, gifting to family, and legacy planning? So, there are a lot of different options in this. It really depends upon your financial plan, but also how much you're wanting to give, when you're wanting to give it. Do you want to do this at the end of life or while you're still living? We really focus on two that make a lot of sense for a lot of our clients. The first one is a donor advised fund. There's been a lot of changes to the taxes and the brackets and standard deductions and things like that over the last handful of years, where it might make sense to use a donor advised fund. So a donor advised fund is maybe you say, I'm going to give $5,000 a year every year for the next 10 years to your charities of choice. Great. So we're talking about $50,000. But if you use the standard deduction every year because all of your other deductions aren't enough to get you above that $32,000 number, I don't want to say you're wasting an opportunity. You're still giving to a charity, which is great, but you could be able to give more to the charity while not taking any more money out of your pocket by taking advantage of the donor advised fund. So the way that works is, you're going to give away $50,000 the next 10 years. You've got that $50,000 now. You can take all of that and put it into this donor advised fund, and you get a tax break year one. So this year, Then that $50,000 is in an investable account. You can invest it just like you can a 401k, IRA, things like that. That account could hopefully go up with market returns over the next 10 or so years. And then you can decide when to take money out of that account and give it right to those charities that you already knew that you were going to do. And you're able to now take a $50,000 tax deduction this year and itemize for one certain year. There's other things that you can do as well too. A lot of times when people are going to like bunch deductions like this, they might end up paying multiple tax years for their property taxes. Maybe they pay, 3 or 4 semi-annual numbers in one given year. They might bunch other charitable donations. They can really look at everything to add it up because you're going to have one year you use the itemized and the next 3 or 4 use the standard. Try to get as much as you can when you do this donor advised fund. I think Brie mentioned earlier the qualified charitable distribution. I think you mentioned that earlier. So what you're able to do with a QCD is if it's time for you to start taking money out of your IRAs because of your required minimum distributions or your RMDs, there are some people that are very fortunate to one, they might not need it, or two, might not need all of it because of other income sources. With the QCD, you're able to satisfy that RMD requirement and you're able to give that money right to a charity as opposed to taking it yourself. So you're able to save taxes on that end as well too. When you're giving to your family, there are some rules that people don't necessarily always follow, but I encourage you to at least follow them and fill out a form. So let's say that you have a kid that's getting married this year and you want to pay for the wedding and you're a really nice parent and it's a really bougie wedding and we're talking about $75,000, right? Well, technically a parent can only give $30,000 a year to a kid without running into a gift tax. Now, here's a really nice thing about this. Every single one of us right now also has $15 million available to give at their end of life to avoid an estate tax. So one cool thing you can do is you can borrow or pre-use from that $15 million as long as you fill out a form. So let's say you're today wanting to give $100,000 to 2 of your kids. The government says you can only give 30,000 bucks a year. You can borrow $70,000 from that 15 million and go ahead and do it. But make sure you fill out the forms when it comes to this because we have seen this come back to be caught on some tax returns and things along those lines. And when it comes to legacy planning, this is a big part of the conversation. I know Brie mentioned this when it came to Roth conversions. What you want to do with money at the end of life is going to significantly change what a lot of recommendations are. And it's a hard topic, right? I had a conversation with some people that were very well off the other day in their late 40s. And they said, hey, we don't even know what we want to do with our money in 15 years for ourselves, let alone in 50 years when we pass it on to the next generation. But these are some things you're going to have to put some thought into to have some conversations with your advisor to make sure that we're making the best decisions for you and your individual situation. All right. We are going to open up the floor in about 3 minutes to answer some questions that are coming through live on the chat. But before we do this, we want to talk about what the next steps are going to look like. So when we look at this, there's kind of 3 options that you have when you are a client of Boldin. The first option is to use the software like all of you are doing today. You are paying that monthly membership fee and you have access to the software. If you are a do-it-yourselfer, this might be what you need. Then there is an option. I know some people asked this question earlier about you want some help with the planner. Hey, where do I look at putting in a Roth conversion? How do I determine if I'm going to get a inheritance in 5 years? Where do I put that? Hey, I'm going to move and downsize to a condo when I hit age 60. How do I do that? So those are things you can absolutely do in our planner, and a coach can assist you in using the planner to the best of its ability. A coaching session is a one-time engagement of $250, and you sit down with a coach who's a financial planner, and you're able to do a live working session for about 50 minutes. Now, I say they're a financial planner. They are not, however, a CFP, and they are not able to answer advice questions. So what does that mean? If you want to say, should I do a Roth conversion? Or how do I determine when to start Social Security? Or Brie mentioned this thing about ACA and I don't want to lose my benefit to that. So how do I plan Roth conversions around that? Or how should I invest my money? Or a million different questions that might be on your mind where you want advice and help. If that's the case, you're going to want to look into our retirement plan checkup and working with a financial advisor who is a CFP. That's the $2,800. I see a lot of people posting about that in the chat here. So for $2,800, you're able to meet with a CFP, have an introductory conversation that's about 45 minutes. You'll get to learn about the advisor. They're going to ask you a ton of questions to make sure that we're going to plan for the best situation for you. Then you're going to get back together about 2 or so weeks later when somebody like Brie will spend a ton of time running analysis, doing research, and drafting an updated plan that best fits your situation. Then Brie's going to come back and explain to you when to start Social Security, how much to do in a Roth conversion, and when to do it, how to allocate your portfolio, which funds should you take money out of or which accounts first. Hey, are you able to spend $10,000 a month and be pretty confident you're not going to run out of money? And how do we get to that? So all of this and all of the questions that you have around financial planning can be answered by a CFP for that $2,800 engagement. So where do we go from here? Sometime today, you're going to get an email from our group that says, hey, great, you were on this call. If you want to learn more, you've got two options. The first option is to meet with yours truly. So you can schedule some time on my calendar and I will help you understand which of those three options is best for you, a do-it-yourself, a meet with a coach, or to meet with a financial advisor, CFP. And I'll also help you determine which one of those awesome CFPs is the best fit for you based on their experience, their expertise, personalities, and things like that. That initial call is 20 minutes with me. It's completely free, and I'll help guide you in the right direction. If you've already done your research or you were blown away by Brie today and you say, I want to work with her, you can go right to our website and schedule directly with Brie. Again, by doing that, you're going to have that initial 45-minute meeting. At the end of that call, there is an $800 deposit that is due. And then Brie goes to work based on what your conversation entails for a couple of weeks. You get back together and she comes to you with a plan presentation on all those recommendations, and you owe that $2,000 balance at the end. We've got 20 minutes left. I'm going to stop sharing my screen so I can see everybody as well as see the questions, but happy to open things up. I know we've answered a bunch, but is there one on here, Brie, that you see you want to jump into?
I believe I saw one that was just clarifying the gift limits every year. It is $19,000 for an individual and then $38,000 if you are married filing jointly. And then in Andy's example of the wedding, you can give $38,000 to your biological child. You can then give $38,000 to their spouse, $38,000 to the grandchildren, all sorts of things. There's another question here that's asking, which is the better strategy? Roth conversion or after-tax contributions and then convert to Roth if you have sufficient cash outside of your retirement funds. I think that the best strategy is very likely a combination of both. Okay. It depends on, how much money you can save in these later years of your working career and making sure that you're still having enough money to live on every month. But, the earlier we can get money into Roth, the better. And then the Roth conversions, we can be very strategic about how much income we recognize every year. And then, can we watch this video again? I believe we're recording, Sarah. Is that correct? No? Okay. All right. So one time, but we've had lots of wonderful response from these office hours. So I truly believe we will do it again. And then if you sign up for advisory services with us, we host a CFP office hours exclusively for advisory clients where it's a very similar format. And we do that once a quarter currently.
There's a couple of questions here about what an ongoing relationship within what an advisor might look like. So the way we have it set up today, it's designed to be about a month or so for that initial engagement. But a lot of our clients like to have a go-to CFP on an ongoing relationship, and that is certainly available for this. So somebody asked, hey, what's it look like year two and beyond, or for my spouse and things like that? If you work with Brie and you get through the initial $2,800 engagement, there are different ongoing relationships that she will talk to you about. There's one that's available if you think you're going to meet every single year on an ongoing basis. There's also some ad hoc things available. You might have a one-off conversation where you're like, hey, Bree, we're set to meet again in 6 months, but I've really got a question I want to meet with you next week about because I'm getting ready to retire. Make sure I don't want to mess this up. So there's things like that available as well, too. Those are certainly things. This is not designed to just be a one-time relationship and be done, but that can be the way it works if that's what you are looking for as well, too. And then Ramiro, unfortunately, this is not a tax deductible thing for 99.99999% of people. So the answer is probably going to be no there for you.
It used to be. Remember those days?
It did,
Okay.
yes, but not anymore. Yeah.
Um, let's see here. Three or four people have mentioned the ACA subsidies. What are the ACA subsidies? They are gone until the government takes action, as far as I know. So there's two tiers of the ACA subsidies. There's the standard subsidies, which from my understanding are still in place. And then there were higher COVID subsidies that were in place for a number of years that's what they're kind of debating on. There's also comments in here about, in general, the ACA subsidies. If your income is below certain thresholds, it's typically 400% of the federal poverty line, depending on your household size. If you're under those income limits or a portion under them, you qualify for credits towards your monthly premium on the ACA open market exchange for healthcare coverage. The limit is 400% of the federal poverty line, depending on how many people you're covering. So if it's you and a spouse, I believe it's about $80,000 to $90,000 a year. That changes every year with inflation. If you're covering you and kids, that's a higher number as well. There is two great resources available. If you go to healthcare.gov, you can fill out the details of your household size, your income limits, and it'll tell you essentially what level of credits you may qualify for. And again, that's just an estimate that's on the ACA website. And then the Kaiser Family Foundation has a great calculator available as well, where you can kind of go through and it'll tell you, all right, this is kind of the break-even point of your income, that if you go over this line, you start to lose these subsidies. And it'll show you the ACA subsidies and the COVID subsidies in case Congress decides to get its act together.
Yep. Somebody asked about how we help with investments because you can't see the investments inside of our tool. You're correct. So when you link an account, we can only see the dollar amounts inside of that account updated each day. We can't see the tickers or the investments that you have. So when you work with a CFP, we'll have you do a spreadsheet that we'll have you fill out that walks through the account type, the dollar amount, and the ticker that you have. And then we'll run a complete analysis on your current financial or your current investment strategy compared to the recommendation that we might have based on your risk tolerance and your financial plan and things like that. So while we don't manage money and charge 1% of assets, asset management and investments are still a big part of this financial planning strategy that we're going to walk through. So we certainly know how you're invested with some help from you and give recommendations on that as well. Jessica, you just asked how many meetings where there'll be for this $2,800 assessment. So you'll meet first with the advisor that you choose if you know which one you want to go with. So let's say you pick Brie. You can schedule directly on her calendar right now, and you'll have an initial 45-minute conversation where she'll ask you a bunch of questions. She'll read through your plan ahead of time, probably have some questions around some things, talk about what your goals are and really what questions that you want to get out of this. And then Bree will disappear for a week or two, do a bunch of analysis and a bunch of optimizing your plan. And then you guys will get back together for an hour to an hour and a half conversation. Well, she'll walk you through all of those recommendations and what it looks like. And then I always say you've got Bree on retainer for another week or so, right? If you have a question once you read through all, you say, hey, Bree, I think you told me to go through the 12% bracket with Roths. Was that starting this year or next year? Bree's going to get back to you for that. And then if you want to continue to use Bree on an ongoing relationship, she'll walk you through how to get that set up, the different cost options that are available. But everyone has to start with the $2,800 retirement plan checkup. You can't go right to the ongoing relationship. This is not because we're greedy and we say we need to make $2,800 first before we make less ongoing. It's because it's our responsibility as CFPs and fiduciaries to look at your entire financial plan. If I ask Bree today, hey, Bree, I make this much money and have this much in assets. Should I do a Roth conversion this year? Bree is going to say, that's a really good question. I have to know about 77 other things about you before I can answer that to make sure I'm giving you the best advice. So everyone's got to walk through the retirement plan checkup, and then we'll talk about ongoing and hourly after that.
Awesome. There's been a couple of questions in here kind of talking about how the Roth Conversion Explorer wants you to do some really aggressive Roth conversions in the early years of retirement that would deplete your taxable accounts, or it's generating really high tax bills that feel scary to pay in the early years of retirement. That's a very common concern, one that we're very familiar with. There are ways within the Explorer to limit the amount of conversion you do. You can protect a certain level of your taxable accounts if that's something you're wanting to do as well. We can teach you how to kind of manipulate the Roth Conversion Explorer to give exactly what we're looking for. So there's always opportunities to do that. And then one thing that I really love about the way that we do the Roth conversion analysis after we, to Andy's point, ask you a million questions and make sure we really understand what you're trying to achieve, and we look at it across your whole lifetime, right? Is that we show you a few different options that meet those goals, right? So you can do less aggressive Roth conversions in the early years of retirement and ramp it up over time if that's something that concerns you, right? There are trade-offs to that, right? The earlier we get that money into Roth, generally the better, but this is your money, right? We want to develop recommendations for you that really make sense for how you think about things, the concerns that you have, how you view the future. We can make the best recommendations in the world, but if it's not something you can reliably execute on, it's not worth much.
Yeah, great question. David just asked, hey, you're already taking out, or you just started taking money out of your IRA balances. Does the software want you to model the transfer with the net or the gross amount? We always want to talk about gross when we're talking about taking money out of an account because Boldin does an awesome job with the calculation. The only time we ever really talk about a net number is when we're talking about what you want to spend, right? So when it asks you what your expenses are and you say, I want to spend $10,000 a month, that is you saying you actually want $10,000 to go out and put back into the economy. Then Boldin will back into that 10,000 and say, hey, it's coming out of these IRAs, Roths, non-taxable accounts, whatever it ends up being. It's going to take out maybe $13,000. So you end up netting that 10 that you want to spend. But if you're talking about how much to take out of an IRA, if you want to take out 12,000 and it ends up becoming 9 after tax, you want to put that $12,000 number in, or that gross number.
We had a question in here about paying the 1% broker fee in the early years of retirement to lock in investments and then transition to doing it yourself. I do see this from time to time because the underlying investments inside the account that you have generally those are your investments, right? You don't necessarily have to work with that company in order to keep those investments. Now, if you transition from a private broker dealer to Schwab may not be able to hold all of those same investments. So there are issues there. But in general, there's a lot of folks who don't want to pay the 1% fee on an ongoing basis, and I totally understand that. Different strokes for different folks. But if you want to have a DIY mindset, it can be helpful to have someone like us or another financial advisor, another financial planner kind of set you up for success and then begin managing things yourself. That's totally an option for you.
Ramiro just asked about setting up some time with me to talk about picking the best planner for them. More than happy to do that. So, what my role here is it's a free 20-minute conversation. We're going to figure out together if you want to keep doing this yourself with the planner, you want help from a coach, or you want help from a financial planner or the CFP. What is best for you based on your situation? If the third one, working with the financial advisor and a CFP for that $2,800 retirement plan checkup is what's best for you, we'll sit down and I'm going to ask you probably 10 or so questions to figure out who is the best advisor for you. Brie is awesome. So are all of our advisors, but some have different specialties. Obviously, they have different personalities and expertise. So we'll work together to figure out who the best one is for you. And then after that 20-minute call, we'll get you scheduled with the advisor that is the best fit, and you can start with that ongoing relationship. We've got a couple of minutes left. Are there any more questions that we want to get through? Anything we missed, Nancy or Sarah, that you want us to answer live?
Could you answer the question of when do you stop worrying about sequence of return risk?
Do you want the politically correct answer? Yeah. So when you're no longer on this earth, you can stop worrying about it, right? So there's some questions in here about Monte Carlo and about sequence of return, right? It really depends upon your situation. So we have people that stay up at night because they have a 97% chance of success inside of Monte Carlo. And we say, guys, when you look at this means that only 3% of the time you had less money left than you wanted to. And that might be giving away $10 million to the next generation, right? So when we see a number that's in the 90s, we are feeling very confident you're going to be able to spend the money you want to spend, live out the lifestyle that you want, and not have to worry about running out of money. We tend to think anything 85% or higher is a really good Monte Carlo score. When you're in the 80 to 85 percentile, maybe that means we might have to, at some point in the future, make some adjustments. Maybe it's spending a little bit less. Maybe it's doing more or less Roth conversions. Maybe it's getting a part-time job in retirement. When we start seeing numbers in the 70s, lower 70s, that's when you're going to have a conversation that says, hey, based on how things look today, we're probably going to have to make some adjustments later on in life. Maybe that means in your 80s, you slow down your travel budget. Or maybe that means instead of buying a $100,000 car in 10 years, you buy a $50,000 car. These are the conversations that you're going to have with your advisor. But people worry about sequence of return risk when they've got a 98 percentile or a 75 percentile. A really cool thing you can do again in the software is go to that market risk explorer and play around with, hey, if I get 7% yearly returns and it goes 7, 7, 7, 7, 7, which it never does, it's going to spit out a number. Then the sequence of return risk, you can say, what if there's a really bad year and I lose 30%? And then I get that 777. And the Monte Carlo throws all of those scenarios 1,000 different times to give you a real life answer. So I know it's not the best response. When can you stop worrying about it? But if you're in, an 85% or higher Monte Carlo, we're feeling really, really good about your situation.
I love this question from Todd. How often would you advise a 49-year-old retiree to get a plan review by a CFP? Again, the politically correct answer is every year. But in general, if you're still several years away from retirement, I would say every 18 months, maybe every 2 years, or as something significant changes in your plan. If you're going to retire next year or in 2 years, I would say, every year. It's really in that kind of like crunch time of a couple of years before retirement, the first couple of years of retirement that really we want to spend a lot of time with our advisor, right? We want to make sure that we understand the financial plan. We want to understand where money is coming from, what the plan is over time, so that we can kind of start to learn these new skills of how to rebalance our portfolio, how to do a cash management strategy, all of that good stuff. But kind of outside of that crunch time, once a year, once every 2 years is totally fine unless something big changes in your life.
Nope. Someone just asked about our values shown in current or future values. It's up to you. So you have the option to show things in future value, which means it takes into account inflation adjusted numbers, or today's value, and it will show you based on inflation. It'll back into it and show you what that money would be worth today. So you have both of those available options inside of the planner as well, too. There are some questions I see that we're not going to be able to get to in the next 30 seconds. So are we going to do our best to get back to these questions that we missed? And we're going to print these off and we'll do our best to get back to you. Again, if you have any questions, we're absolutely here. We're going to start doing these types of live Q&A sessions more frequently. So if you don't get to your question this time, we apologize. We'll do our best to get back to you and get things rolling. But we've got 1 o'clock. I know Bree's probably got a meeting. I've got a meeting. We really appreciate you guys being here. You're going to get an email from us this afternoon to either schedule right with a planner or schedule with me to help you throughout that process. Any questions, feel free to reach out. If not, everyone have a phenomenal, it is Thursday afternoon, and we'll chat with you soon. Thanks, everybody.